Welcome back to the deep dive. Today we're dusting off a file that I honestly thought we'd have archived permanently like 3 years ago.
Yeah.
We're talking about the corporate zombie that just refuses to stay dead. Or, maybe the phoenix rising from the ashes. We're talking about GameStop.
It is the story that never, ever ends.
Yeah.
Just when you think the credits are rolling, boom, there's a post-credits scene that just changes the whole plot.
Exactly. And I think for a lot of our listeners, GameStop is sort of frozen in amber. You think of 2021, you think Reddit, Diamond Hands, the memes.
The congressional hearings?
Oh, yeah, it was a whole cultural moment. But we're in 2026 now. The memes have faded, mostly. But the company, it is still here.
Yeah.
And it is doing some genuinely strange and fascinating things.
It's a completely different animal today. I mean, if you're still looking at GameStop through that 2021 lens, you are missing the actual story.
Right.
We're looking at a company that is like a laboratory for a very weird experiment in modern business.
And the reason we're pulling this apart today isn't just nostalgia. It's because of a very specific, very loud signal coming from inside the house. The CEO, Ryan Cohen, just made a move that, well, it forced everyone to pay attention again.
A $10 million move,
Yeah.
to be precise.
Yeah. So here's our mission for this deep dive. We're going to strip away all the internet noise. We're going to look at the cold, hard numbers from the first 10 months of 2025.
Yep.
And we need to figure out, is this a dying brick and mortar chain that's just taking a long time to flatline? Or is this actually a successful pivot into something new?
It's the ultimate turnaround test.
Yeah.
It's got this new insider buying, you have a radical shift in where the revenue is coming from, and a balance sheet strategy that honestly looks more like a hedge fund than a video game store.
And spoiler alert, Wall Street has absolutely no idea what to do with this thing, but we'll get to that. Let's start with the news trigger, Ryan Cohen.
Right. The Chewy founder, activist, investor, the meme lord. And since late 2023, the official CEO.
And he just opened his personal wallet. What do the filings actually tell us?
The filings are crystal clear. Cohen went out and purchased 500,000 shares of GameStop on the open market.
Okay.
And he didn't even buy them at the absolute bottom either. His average cost basis was around $21.12 per share.
Let's just pause and do the napkin math on that. That's a massive check to write.
It's over $10.5 million, and this is really important context. This isn't stock options from the board.
Right, it's not funny money.
No. This is him taking actual cash from his own bank account and buying stock because he wants to own more of it.
Which brings his total stake to what now?
He now owns over 9% of the company's outstanding shares. He is heavily, heavily leveraged to the success of this stock.
Okay, so let's play devil's advocate for a second. CEOs do things for optics all the time. Is this just a PR stunt to, rally the troops? Or does it mean something more?
Well, in finance, we talk about this concept of asymmetric information. It's just a fancy way of saying Ryan Cohen knows more than we do.
A lot more.
He sees the daily sales reports. He sees the profit margins on every little Funko Pop they sell. He knows the strategic roadmap for the next 5 years. He's looking at the cards while we're just looking at the backs of them.
Okay.
And there's this old axiom on Wall Street I love. Insiders sell stock for a million reasons.
Yeah.
They're buying a beach house, paying for a divorce, diversifying.
Just paying taxes.
Exactly. But they only buy stock for one reason.
Because they think the price is going to go up.
Precisely. It's the purest signal of bullish sentiment you can get. He's effectively saying, hey, the market is valuing my company at $21. And I think that's wrong. I think it's worth more.
It's definitely a huge vote of confidence, but, and this is a big but, just because the CEO believes in the vision doesn't mean the vision is working yet. I mean, he could be wrong.
Oh, absolutely. That's the risk. History is littered with CEOs who bought stock on the way down to zero. He's betting on his ability to execute. But the reality of what he's executing on is, well, it's complicated.
Let's get into that reality. Because I walk past the GameStop at the mall, and it just feels like a time capsule. We live in a digital world. I haven't bought a physical game disc in years. How does this business actually survive in 2026?
That is the existential crisis they are fighting.
Yeah.
And to understand it, we have to stop looking at GameStop as one big blob and, break it down. We've got the financial reports for the first 10 months of 2025.
Okay.
And if you look closely, the business is actually 3 different businesses inside a trench coat.
I love that image.
Sure.
Okay, unbutton the coat. What's business number 1?
Bucket number 1 is hardware. Consoles, controllers, VR headsets, all the actual gear. This has traditionally been the anchor of the store.
And how's that anchor holding up?
It's surprisingly stable. I mean, it's down, but only by about 5%.
Down 5%. Honestly, I would have expected worse, given how old the current console generation is getting.
It's actually not bad at all.
Hmm.
You have to remember, you can't download a PlayStation 6, right? Hardware has this physical stickiness.
Right.
GameStop is still a main destination for parents and gamers to go pick up the actual box. A 5% decline in a mature hardware cycle is manageable. It's a slow week, not a burst pipe.
Okay, so hardware is keeping the lights on. What's in bucket number 2?
Bucket number 2 is the disaster zone. This is software. New video games.
The thing the store is named after.
Correct. And this is where the digital revolution is just absolutely eating them alive. Software now accounts for the smallest share of their revenue.
Wait, the smallest. Smaller than T-shirts and toys.
Yes, and the revenue in this segment plummeted 27% year over year in that 10-month period.
27%? That is a crash. I mean, that's a quarter of your business just vanishing in a year.
It's a hemorrhage, and it's structural. This isn't because GameStop is doing a bad job selling games. It's because consumer behavior has permanently shifted.
Of course.
Why drive to the mall to pay $70 for a disc when you can just click download on your couch at midnight and play instantly?
The convenience factor has finally totally won. The game part of GameStop is literally evaporating.
It's melting like an ice cube in the summer. And Cohen sees this. He knows he can't stop that digital shift.
Yeah.
So the entire strategy really hinges on bucket number 3.
The pivot.
The pivot. Collectibles.
We're talking about the toys, right? The Funko Pops.
We are talking about Funko Pops, action figures, trading cards, vintage gaming gear, apparel, plushies. They are trained to shift the identity of the store from a place you buy a game disc to a place where you buy culture.
So it's becoming a fandom shop.
Exactly. They are trying to be the hot topic or box lunch for the gaming demographic. And here is the data point that explains why Cohen is optimistic.
Okay.
In that same period where software crashed 27%, the collectible segment grew by a massive 55%.
55% growth. That is explosive for a brick-and-mortar retailer.
It's unheard of. It validates the idea that while people won't drive to the mall for Call of Duty, they will drive to the mall to hunt for a rare Pokemon card or a limited edition Zelda hoodie. You can't download a plushie.
That is a really smart distinction. Physical goods for a digital culture. But here's the skeptical question I have to ask. Can selling $15 toys really replace the massive revenue hole left by $70 video games?
That is the $10 million question. Generally, the profit margins on collectibles are better than on new video games, so that helps. But the sheer volume they need to sell to replace the software business, it's staggering.
It feels like they're changing the engine of the airplane while they're in midair.
And while one of the wings is on fire.
Right, so you've got this race against time. Can collectibles grow faster than software dies? But that's just the retail side. If that was the whole story, it'd be a standard turnaround. But Cohen is doing something else that makes this totally unique. We have to talk about the Bitcoin thing.
We do. And this is where GameStop really separates itself from, say, a Best Buy or a Radio Shack. Under Cohen, GameStop has started using its corporate cash reserves to buy Bitcoin.
Okay, let's just make sure the listener understands this. This is not them accepting Bitcoin at the register for a game.
No, absolutely not. This is a treasury strategy. Every company keeps cash in the bank to pay bills, salaries, rent. Usually that cash just sits in short-term government bonds or a savings account.
It's the safe money.
Right. But Cohen looks at that and he sees lazy money. He's effectively mimicking the strategy that was popularized by MicroStrategy. He is taking the firm's capital and converting it into cryptocurrency, treating Bitcoin as a long-term asset.
That is incredibly bold for a mall retailer.
It's aggressive. It signals that management believes they can get a better return by holding Bitcoin than they can by investing that same cash into opening more stores or, building new retail tech.
Which is a bit of a double-edged sword, isn't it? On one hand, if Bitcoin goes to the moon, GameStop's balance sheet looks amazing. On the other, isn't it kind of admitting we don't know how else to grow our core business, so let's just gamble on crypto?
That is the primary critique. Is this innovative finance or is it a lack of ideas? However, we have to give credit where it's due on their boring financials. Because while the crypto stuff grabs headlines, the operational discipline has been ruthless.
You mean the cost-cutting?
Yes. For the last 2 years, they've been slashing expenses, selling off non-core assets. They're closing underperforming stores relentlessly. They are shrinking the footprint to save the body.
The classic turnaround playbook, cut the fat to find the muscle.
And it is working, at least on paper. When you look at the profitability for the first 10 months of 2025, there's a serious turnaround.
Give us the numbers.
They significantly increased operating cash flow. But the headline number is this. They generated 67 cents of diluted earnings per share, or EPS.
67 cents of profit per share.
Yes. Compare that to a year ago or 2 years ago when they were posting losses every single quarter. They aren't bleeding cash anymore. The patient has been stabilized.
Okay, so let's synthesize this picture. We have a shrinking hardware business, a collapsing software business, a booming collectibles business, a Bitcoin treasury, and a profitable bottom line.
That's the summary.
Honestly, that sounds okay. Like they survived the worst of it. So why is there still so much debate? Why are people warning us away from the stock?
Because in investing, there's a difference between a good company and a good stock. A good company makes money. A good stock is one you buy at the right price. And the problem with GameStop right now is the price tag.
So let's look at the valuation. What is the market asking us to pay for this Franken business?
The stock's hovering around, what, $22.99? That gives the company a market cap, the total value of business, of somewhere between $9.7 and $10 billion.
$10 billion.
And here's a really surprising fact about that. Usually, a $10 billion company has a swarm of Wall Street analysts covering it. You'd have reports from Goldman Sachs, Morgan Stanley, JP Morgan.
Of course.
I checked the data for GameStop, according to Yahoo. Finance currently, only one Wall Street analyst covers the stock.
Wait, seriously, only one?
Just one.
That is wild. This is one of the most famous, most traded stocks on the planet. Why is Wall Street ignoring it?
Because it's a career risk.
Yeah.
It breaks all of their models. The volatility is insane, the meme crowd is unpredictable, and now you have Bitcoin exposure mixed in. If you're an analyst and you say sell, and the internet mob drives the price up 50%, you look like an idiot.
And if you say buy and Bitcoin crashes,
you also look like an idiot, so they just toss it in the too hard pile and ignore it.
That makes a lot of sense. It's just radioactive for the institutional types. But we do have projections from this one brave analyst, right?
We do. This Lone Ranger projects nearly $1 of earnings per share in 2026, with total revenue of about $4.16 billion.
Okay, so if they hit that $1 profit per share and the stock is trading at 23,
that means the stock is trading at roughly 23 times forward earnings.
Okay, let's unpack that multiple for the listener. Is 23 times earnings expensive? Cheap? What's the context?
It depends entirely on what you compare it to. If this were a high-growth tech company, think NVIDIA or something, trading at 23 times earnings would be a bargain.
Right.
You paid a premium because you expect earnings to double every year.
But GameStop is not NVIDIA.
No. It's a retailer, and typical retailers, even healthy ones like Best Buy, usually trade at around 10 to 12 times earnings.
So GameStop is trading at double the valuation of a normal, healthy retailer.
Exactly. The market is pricing it like it's a growth company. But when you look at the revenue, remember that 27% drop in software? It doesn't look like a growth company yet. It looks like a shrinking company with a really nice side hustle.
So the argument is that the stock is just plain expensive.
Our source material argues that the valuation is rich. You're paying a premium price today for a turnaround that hasn't actually finished yet. You're paying for the hope that collectibles and Bitcoin will pay off, not the certainty.
It's like buying a house because you think the neighborhood might get better in 5 years, but you're paying the better neighborhood price today.
That is a perfect analogy. You're pricing in a victory lap before they've even crossed the finish line. And we have to note, the market is aware of this. The stock is down about 21% over the past year.
Right.
That tells us that meme premium is slowly deflating. The air is coming out of the balloon.
So we have this fascinating conflict. On one side, you have Ryan Cohen, the insider, putting $10 million down, saying, this is cheap. On the other, you have the fundamental math saying, at 23 times earnings, this is expensive. Who's right?
And that's the battleground. Cohen has a much longer time horizon than we do. He might be looking at 2030. He sees a fortress balance sheet, lots of cash, no debt crisis, Bitcoin upside. He can afford to wait 5 years.
But can the average listener afford to wait 5 years?
That's the key. The source material we analyzed concludes with a big yellow caution sign. They explicitly say they would avoid it right now.
Even with the insider buying?
Even with that, because insider buying is a signal, but it's not a guarantee. We've seen plenty of CEOs buy stock right before it drops another 50%.
True.
The valuation is stretched. If the economy slows down or if the Bitcoin market takes a dive, that $23 stock price has a long way to fall before it hits fair value.
It feels like GameStop has graduated from being a meme stock to a legitimate battleground stock. It's not about sticking it to the hedge funds anymore. It's about a genuine disagreement on the future of retail.
It really is a case study in modern markets. You have the fundamentals fighting against the narrative. The narrative is, in Ryan Cohen we trust, the fundamental is we are losing our core business.
And the collectibles are the wild card. If that 55% growth continues for another couple of years, maybe the narrative wins.
Maybe. But trees don't grow to the sky. Sustaining 55% growth gets harder and harder the bigger that segment gets. I mean, eventually, you run out of people who need a new Funko Pop.
That's a fair point. Before we wrap up, though, I want to circle back to that Bitcoin point one last time, because I just want the listener to really picture this boardroom meeting.
Go on.
You have a company born in the shopping mall. Their DNA is brick and mortar, strip malls, physical media. And they sit down and decide the best way to protect their future isn't to build a better e-commerce platform to fight Amazon. It isn't to build a digital game store to fight Steam. It's to buy cryptocurrency.
It's a profound statement on the state of the economy, isn't it?
It really is. And I want to leave the listener with this question. Is this the ultimate genius move of forward-thinking treasury management? Is GameStop actually ahead of the curve, showing us the future of how corporations should handle cash?
Nah.
Or is it a white flag? Is it a sign that they literally have no idea how to invest their cash to grow their actual business operations? Is it a sign that says, we can't win at retail, so let's become a crypto holding company instead?
Is it 4D chess, or is it just a lack of ideas?
Exactly. We will let you decide.
Indeed.
That's all for this deep dive into the strange, enduring, and evolving life of GameStop. Thanks for listening, and we'll catch you on the next one.